esteemed guests. My name is Edward Sterck. I'm the Director of Research at the World Platinum Investment Council, or WPIC. This morning, my presentation is going to be on the influence of tariffs on PGM markets. I mean, certainly we live in interesting times. I'm sure there's many people in history who felt just like that, but certainly today it does feel like uncertainty is ratcheted up to recently unprecedented levels, and this is obviously having an influence on the markets and including on the markets for platinum group metals. Just a quick introduction to the World Platinum Investment Council, or WPIC, for anyone unfamiliar with us. I'm sure most of you are. We're funded by the South African platinum producing companies for the most part, and then also have some pre-production companies who recently joined us with exploration assets in Brazil and in Australia. Our role is to grow investment interest in platinum specifically, but we advocate more broadly for the platinum group metal suite and also for the hydrogen economy. And how do we grow investment interest in platinum? Well, we do this in two different ways. So firstly, we partner with a variety of mints, refineries, bullion fabricators, bullion dealers in different locations around the world, and we help them to design, produce, market and sell platinum investment products, bars and coins, and that's predominantly to a retail investor audience. We then also engage with institutional investors, and this is the side of the organization that I'm in charge of. So we produce what is effectively sell-side commodity analysis of the platinum group metals and market dynamics. We go around the world and engage with institutional investors, so these are pension funds, hedge funds, and so on, metals trading desks, and we try to help them understand the dynamics that are influencing the market and helping to determine value establishment and give them insights into what's driving those factors and try to make them better informed so that they are in a position to more rapidly make investment decisions when it comes to platinum. So, moving on to the topic of today and tariffs. What are import tariffs? Well, principally it's a form of trade control and also a mechanism for raising government revenue. It is in effect, despite what Donald Trump has been telling people, it's not a tax on the countries that are providing goods for import into the US, but it's really a tax on the domestic consumer. It's important to notice that the US has got a long history of trade controls. In fact, if you look back, I suppose in some ways, the US War of Independence was arguably a response to British trade restrictions. And in fact, actually, the first piece of major legislation passed by the fledgling US government post-independence was the Tariff Act of 1789. This act had two purposes. So firstly, it was to raise revenue for the US government and pay off debts from the War of Independence. And it was also an effort to try and protect the US economy from a flood of cheaper European goods coming into the market. And it was put in place after the US government tried to negotiate with various different European counterparties rather unsuccessfully. Now, it's also worth noting that Donald Trump clearly loves tariffs. He's advocated for them since the 1980s. They were a pretty significant part of his first term as president and a key pillar of his 2024 election campaign. He's using them not just as a tool to try and re-domicile industrial production into the US, but also as a form of policy enforcement. An example of this would be his linkage between his application of tariffs on Mexico and Canada to fentanyl production and illegal immigration. In terms of the, how this sort of all began to unfold, really post the election, the tariff rhetoric coming out of the incoming Trump administration began to increase. And in terms of the impact on the markets, that really began to come into effect and begin to influence market dynamics in December of last year. Why did it have an influence on the PGM markets? Well, the US is a fairly important trading hub for PGMs. It's a reasonably sized consumer, but it's also got a big metals trading industry. You've got the futures exchange there in the form of the CME and NYMEX. And you can see here illustrative trade flows from 2023. So the US imported around 156 tons of platinum and exported around 93 tons. I should say, however, just treat these numbers with a bit of a pinch of salt. Trade data is really only as good as the reporting, and it is not 100% reliable, but it is indicative of the flow of these metals. So in terms of how the sort of fear factor began to emerge in the US and how that began to be reflected in the markets, it's worth just thinking about the US's positioning in terms of its domestic supplies of PGMs relative to its demand. If you look at the left-hand chart on this page, you can see that the US is effectively almost self-sufficient when it comes to palladium. So US palladium demand in any given year roughly equals the domestic mine supply of palladium plus palladium available through recycling supplies. But you can see that clearly in terms of platinum, the US is extremely short of platinum versus palladium. And in terms of how that influenced the markets, starting from December, we began to see some tension coming into the platinum market. Lease rates began to go up. These are highlighted in the right-hand chart on this slide. And we also began to see metal flowing from Europe in particular into the US ahead of tariffs. There was uncertainty, obviously, as to whether critical metals like PGMs would be subject to tariffs or if they'd be exempt. And so we saw proactive efforts to onshore metal in order to make sure that end users were not caught out in the future. Clearly, again, reflecting on the difference in terms of the US's domestic availability of these two metals, you can see that it's platinum release rates that reacted, not palladium's. So this chart here shows, in the black line, exchange stocks on the CME. So these are physical bars of platinum that are lodged in approved warehouses, effectively, as collateral for short positions in the futures market. And in essence, what we saw was, because of the concerns around the potential for tariffs to begin to be applied to the PGMs, and platinum in particular, we saw that resulted in a steepening of contango in the US futures market. That created an arbitrage opportunity for speculators who could go short in the sort of 3 or 6 month out futures and long in the prompt market and capture the value disconnect as time closed the pricing differential between the spot price and those future prices. Obviously, to take those short positions, metal had to move on exchange, so it had to be collateralized with physical flows of metal into these approved warehouses. And you can see that resulted in those significant increases in exchange stocks. And this is actually just in some ways the visible area where we can see, or I suppose the reflection of that trade flow from Europe into the US and where it's visible. Clearly, once a bit of certainty came into the market, Liberation Day, as Trump termed it, which I think was on the 2nd of April, if I recall, or thereabouts, that gave a higher degree of certainty that the platinum group metals were not going to be subject to tariffs. And so we began to see that contango ease in the US futures market, and the requirement for having that metal on exchange begin to abate, and so that metal flowed out of NYMEX. Part of that, of course, is because it wasn't doing anything there. Once the arbitrage opportunity had been taken advantage of, then clearly you'd want to move that metal back to Europe, take advantage perhaps of the high lease rates, and lend that metal out. I think it's probably worth just reflecting on these tariffs in an historical context as well. So if you look at this chart, you can see these are US domestic import duties through history, starting from that Tariff Act of 1789 I mentioned earlier. And clearly, whilst tariffs in recent times and the era of free trade are somewhat of an aberration, you can see that from an historical perspective, actually, 25% or wherever they end up is not necessarily that high. So it provides some context here. What this chart doesn't show is that historically, tariffs were a key part of revenue generation for national governments, in this case the US. And over time, as free trade increased, i.e. tariffs had come down, that form of revenue generation was replaced by personal income tax. So if you chart personal income tax on this, you'd see that from really around the kind of 1930s onwards, personal income tax comes into force as a mechanism for raising government revenue and broadly replaces tariffs. So free trade is replaced with personal taxation. I think it's also worth commenting here on how these tariffs were put in place by the US government. And it really was actually fairly crude in terms of the way they were calculated and enacted. So Liberation Day, President Trump provided a list of tariffs for different jurisdictions around the world, and some of them were pretty strange. So if you look at this example on the right, we've got some penguins here protesting against tariffs on the otherwise uninhabited Heard and McDonald Islands, which is an Australian overseas territory in the Indian Ocean. They've been subjected to a 10% tariff despite the fact that they don't produce anything. Well, the penguins might disagree, but they don't produce anything for international trade. And so when you dig down into it, it looks like these tariffs were calculated based upon internet domain names being the defining factor for different geographies. So different parts of Australia have got different internet domain names, and as a result, they're subjected to different levels of tariffs. You'll see at the bottom of the slide, I've noted that after Liberation Day, there was a 90-day pause in the tariffs being brought in, which was scheduled to finish tomorrow. Overnight, of course, we've heard that there have been some changes to that, so that date has been pushed back to the 1st of August for most people. There's also some ramping up of the rhetoric on different countries. So we've got up to 25% being threatened for Japan and South Korea as additional tariffs, 30% on South Africa. Difficult to know whether that's still going to exclude PGMs or not, but I imagine it probably will do. And also plus 10% on any tariff rate for any country that's aligning with BRICS from a policy perspective. If there's no deal by the 1st of August, they're currently threatening 70%. So clearly, there's a lot of ongoing uncertainty. We don't know where this is going to end up. And I think that's probably going to continue to result in volatility in markets, including in the platinum markets. So taking this sort of tariff rhetoric and I guess the uncertainty and trying to translate this into meaningful forecasts in terms of the supply and demand for platinum and palladium. Well, how do tariffs influence the PGM market specifically? I'm just running through the different areas here. So on the left-hand side, we've got supply. And starting with mine supply, you can see that as things stand at the moment, and again, this is all subject to change, but as things stand at the moment, mine supply is fundamentally unimpacted. Ingot, grain, and sponge are exempt from tariffs. Interestingly, in terms of recycling supply, there is actually a fair bit of uncertainty. So if you look at the HS codes, those are the codes that you use for international trade of materials, they're actually the same code for new catalytic converters, which would be subject to tariffs, but also spent catalytic converters. So this is causing some disruption, at least in the short term, in terms of the flow of spent catalytic converters in and out of the US, and therefore applying a little bit of near-term pressure to recycling volumes. But I think there are workarounds that people are trying to come up with here, and so for the time being, we haven't changed our estimates for recycling volumes as a result of this, but there's possible downside risk to that recycling supply. Turning to demand on the right-hand side of this chart, it's worth noting, of course, that tariffs are inflationary and therefore potentially negative for demand. In terms of automotive demand, with certain exceptions, so the UK, for example, has apparently negotiated a 0% tariff on the first 100,000 vehicles to be imported into the US. Other vehicles and other non-USMCM parts, so that's the North American Trade Agreement, will be subject to tariffs of around 25% as things stand currently at the moment. I think one of the things to reflect upon with regards to the exemptions is it does show there is potential for flexibility here, which obviously means that these could be the high watermark of the tariff rates, and things may ease a bit. In terms of automotive demand, we estimate that there is some price elasticity between the tariff rates and the feed-through impact on price, and therefore translating that into demand. So every 1% increase in vehicle prices in the US reduces demand by about 0.5%. With the tariffs as they currently stand, we estimate that that's going to reduce new vehicle demand in the US by about 1.7 million units per year. Translating that into PGM demand, that reduces platinum demand by around 1.6 tons and palladium demand by around 6.2 tons per annum. Jewelry demand, again, tariffs look like they're going to be about 25% per annum. And in terms of the impact, we think most jewelry fabrication can probably be onshored in the US at the high end, luxury end of the segment. They may even be absorbed by the retailers. We are seeing some impact, so Fabrication that's been occurring in India for export to the US looks like it's under threat, so that's taken around 1.4 tons of platinum demand out of our forecasts. But overall, we think that the jewellery impact will be relatively short-term, and it's probably being offset by strength in jewellery demand for other reasons, which I'll come back to shortly. In terms of industrial demand, this is an area probably of a higher degree of uncertainty, but it's going to be more longer-term in terms of the impact. Again, 25% tariffs look likely on any fabricated PGM-containing products, so that would include things like catalysts for industrial applications. We think a lot of this production can be onshored in the US, so we haven't changed our forecasts for industrial demand as yet. The bigger threat to industrial demand is probably more in terms of the potential for these tariffs to slow global economic growth, and so for that to erode demand for the end products of the industrial output over the medium to longer term. And then finally, investment demand. Some investment products are exempt, so any legal tender, for example, that's obviously coins, whereas other investment products like bars look like they're going to be attracting a sort of 10% or higher tariff rate. There are, again, possibly some workarounds there, but we have reduced our forecast for 2025 investment demand in the US by 0.5 ton of platinum as a result. So in summary, the direct impact of tariffs actually aren't necessarily that big. I mean, ultimately it translates in platinum terms to around 3.5 tons of platinum. That's only around 1.4% of total 2025 demand. But just to stress, that is the direct impacts. The indirect impacts are more in terms of the risk to global economic growth. As things stand at the moment, we've seen the forecasts being put forward for GDP growth being trimmed by almost 0.5%, so a relatively significant negative hit to the global economy. We are seeing inflation easing despite the tariffs, but the impact of inflation is pretty uneven. Overall, it's coming down, but we're kind of expecting that to be more persistent in the US, clearly as a result of the tariffs increasing the cost of goods sold there. As a result of this, we're also seeing a divergence in monetary policy in different geographies around the world. Overall, the trend is for easing, but clearly we're seeing a more cautious pace in terms of rate reductions in the US, where interest rates are expected to remain higher for longer. And then in terms of the regional dynamics, as I said, there is this sort of divergence across the different geographies. Clearly, the US is obviously an area where things are looking more challenging. We've also got relatively weak momentum in Europe, but not too bad. Perhaps there's the potential for fading stimulus in China, but we've also got some headwinds facing emerging markets. A good example of the impact of GDP on PGM demand can be found in the automotive sector. So if you look at the left-hand chart on this slide, you can see that there's a high degree of correlation between GDP growth rates and demand for vehicles. And you translate that into our forecasts for new vehicle demand going forwards over the medium to longer term. As a result of that, those downward revisions to GDP growth expectations, we've revised down our light-duty vehicle demand forecasts by almost 2 million units per annum. That's out of a total market today of around 90 million units. So, it's a reasonable reduction. We think that impact is probably more likely to be felt, more significantly felt in battery electric vehicles than necessarily for ICE-containing vehicles, so pure internal combustion engine or hybrid vehicles. And that's principally because battery electric vehicles generally are still more expensive for consumers. So you reduce the consumer spending power. Obviously, they're going to vote with their wallet in terms of their purchase decisions. They're more likely to buy the lower cost vehicle in terms of the upfront financial commitment, and that favours ICE and hybrid vehicles over BEV. How does that translate into platinum demand? Well, on our numbers, 2 million fewer vehicles, depending upon the year, results in 3 to 5 tons per annum less platinum demand and 15 tons per annum or thereabouts less palladium demand. A second order impact of reduced demand for new vehicles, though, is that you're also likely to see reduced recycling supply. Clearly, if people are buying fewer new vehicles, they're running existing vehicles for longer, and so scrappage rates are likely to fall. this really would just be compounding a trend we've seen over the last few years. So if you look at the dotted lines here for palladium and for platinum, you can see that there's been an overall trend over the last few years to continually revise recycling rates or recycling expectations lower. The reason for this is, certainly our recycling model is fairly unsophisticated in some ways. Our assumption is that what went into the automotive industry in the past has to come out in the future when those cars have reached their end of their lives, less a recovery factor. But we're just not seeing that come through. And part of that, of course, is economics. At current palladium and rhodium prices, which are really the bigger or more important metals in terms of driving value for the recyclers, those prices at the moment are, compared to where they were over sort of 2020 to 2023, at relatively depressed levels. And so the economics just aren't that supportive for necessarily recycling all of the catalytic converters that are available. Remember that in a typical vehicle's exhaust system, you've got, it's not just one catalytic converter in there, there's usually two or three. A lot of the PGMs are kind of concentrated in one particular catalytic converter. The other one or two catalytic converters in that system are relatively lower grade. And so just lower, the economics of recycling that spent catalytic, or those spent catalytic converters is just that bit less attractive. Oh, sorry, I should just say, in fact, going back to the previous slide, if we were to flatten our forecasts for palladium recycling rates today, that would reduce our future supply forecast by 32 tons. For platinum, that figure would be about 8 tons. So you can see the impact of recycling on supply-demand fundamentals and supply-demand balances actually could be quite significant. So it isn't all doom and gloom. This is stepping aside slightly from the tariff question, but despite tariffs, we are seeing some pretty strong momentum in other parts of the market, principally in investment demand for platinum products, and then also in terms of jewelry demand. Starting with investment demand, and this is really a China story, you can see that thanks to my colleague Weiben and his team here in Shanghai, and their strong advocacy for platinum investment in China, the market here has gone from effectively zero in 2018 to being something akin to 250,000 ounces or 8 tons as of last year. So that's quite significant growth, and China's now overtaken the US as the biggest market for platinum investment products globally. In terms of jewelry, this has been touched on earlier by Trevor, but gold jewelry sales in China were down 32% year on year in the first quarter of this year. Platinum jewelry fabrication, bit of a distinction there, platinum jewelry fabrication rose 26%. So clearly we're seeing some strong efforts being put in place by the fabricators and retailers in China to try and compensate for falling gold jewelry sales by pivoting into platinum offerings. That's obviously in response to the high gold price. So I think the concept here is not so much that the price of gold is too high for consumers to afford, but it's more a perception of where the price risk is. For gold, arguably at these levels, it's possibly to the downside in the minds of consumers, whereas for platinum, given sustained market deficits going forwards, the potential there is considered perhaps to be more in terms of upside. It's important to note that whilst the chart I've shown here is on the top is for China, this isn't just a China story. We are seeing the impact of high gold prices being felt more broadly, and particularly in Europe and North America, where there is a big white gold component to the gold jewelry market. And we're beginning to see at the retail level that white gold products are being priced at a premium to platinum products, and given that white gold as a metal or an alloy was originally developed as a low-cost alternative to platinum, and platinum in the minds of most consumers in Europe and North America is considered to be a premium product. If you're offered a white gold ring or a platinum ring at a lower price, most consumers in Europe and North America are going to choose the platinum one. So we are seeing the impact of these high gold prices being felt on the jewelry markets globally, and certainly that tailwind looks like it might be set to continue. If we project forward these, the sort of tailwinds that we're seeing for investment and gold jewelry, and translate that into future demand, it could add 10 tons per annum to investment demand over the next 5 years or so. And in terms of jewelry, that may be something like 20 tons per annum. So, there is potential for some pretty meaningful demand growth to come from these sectors that could more than compensate for any tariff risks to the automotive or industrial sectors. So just putting this all together and focusing on 2025 and looking at the impact of the direct tariffs versus the growth potential from jewelry and from investment demand. You can see, as I mentioned earlier, the headline impact for US tariffs. It's only 3.5 tons for platinum. That's around 1.4% of global demand for this year. And in terms of our numbers, it's being more than offset by the growth in jewelry and investment demand. So we're forecasting total demand for 2025 of almost 250 tons of platinum. Just turning back quickly to the pricing action here and looking at the gold versus platinum price, clearly you can see that over the last 4 years, the gold price has outperformed platinum pretty strongly. This is driven by the pivot from various different reserve currencies around the world into gold as an alternative currency-like asset, as well as by consumers making a sort of similar switch. Platinum, however, has woken up. As you'll see on the next slide, we're forecasting significant market deficits for the foreseeable future. And it looks like that tightness that's possibly been accelerated by the tariff effects that began to emerge in December 2024, promoting the discovery of tight market conditions, and that's begun to translate into platinum's price action and price activity. It's worth noting, of course, that that dramatic rise in the price of platinum has captured more people's attention, so we're seeing more retail investor interest. We're also seeing more interest coming from institutional investors, and that's being facilitated to a degree by a lot more press coverage as well. Just turning to the right-hand chart on this slide and finishing off with a little bit of review of how this is affecting the market here in China. You can clearly see that if you look at the price versus volumes on an historical basis, prices in blue on this chart, volumes on the SGE are in red, and then import volumes are the grey columns at the back of the chart. You can see that there is a strong correlation between price and import volumes or trading volumes on the SGE. So when price goes up, you tend to see buying interest fade away in China. And what we've seen over the last couple of months is, interestingly, the price has gone up, but we've seen a pretty strong continuation of buying activity in China, which suggests that the value proposition in China is changing, perhaps towards being more comfortable with a higher platinum price going forwards. And just finishing off with our supply-demand outlook for both platinum and palladium, you can see in the left-hand chart here, we've got these deficits in the platinum market that have been embedded for the past 2 years at around 30 tons per annum. Going forwards, we expect those deficits to persist, and that's driven by some modest demand growth being driven mainly by investment in jewelry, but mainly by supply constraints. So put simply, mine supply plus recycling supply isn't adequate to satisfy demand. In palladium, on the other hand, in the right-hand chart, you can see that we've got palladium moving into a surplus from next year. It's worth noting that that is entirely contingent upon the growth in recycling supply that I showed earlier. If recycling supply does not manifest at the same level that we're forecasting, and if you recall, I think I said that it's 32 tons of additional recycling supply coming through over the next few years, you can see that any kind of erosion to that supply growth from the recycling industry keeps palladium in a deficit, or at least, at the very least, a much tighter market for the foreseeable future as well. So with that, I'll thank you all for your attention. I'm available for questions. You can reach me at any time during the conference or on LinkedIn. Thank you, and goodbye.